Welcome to REITs in a Post-COVID Landscape, a four-part webinar brought to you by The Edge Singapore. The series is sponsored by Elite Commercial REITs and RHB.
It's in a post-COVID landscape. Hello again, everybody. Welcome once again to REITs in a post-COVID landscape, and thank you for joining us on a Saturday afternoon. I hope you've enjoyed the past three sessions by our speakers. Vijay gave us some pointers on the most resilient post-COVID REITs and included three of his top picks. Matt's presentation was on the outlook for UK commercial property and why it's been a favourite with Singaporean investors despite its challenges. Shaldeen presented a resilient gem, Elite Commercial REIT. Shaldean's presentation included an outline of the REIT's latest acquisition, on which we've received some questions. So, welcome to our panelists. Without further ado, let me bring on the panelists for today. We have Vijay Natarajan, Real Estate and REITs Analyst, RHB Bank, Singapore, Matt Oakley, Director of Savills from London, and Shaldeen Wang, CEO, Elite Commercial REITs Manager. A good afternoon from us here in Singapore, and a good morning to Matt in the UK, where it's 6 a.m. in the morning. Right. Now, I'm going to kick off with our first question. What are the most important factors to consider when investing in REITs? And I'll put this first to Vijay.
Thanks, Goola. Thanks for having me in this presentation. Okay, the most important factors, I have covered some of these factors in my presentation also. In the end, if you look at REITs, investors are investing in real estate. So the first and foremost factor is asset quality. What is the quality of the asset? A good quality asset can ride through different market cycles. So asset quality is the first important factor I would state as a most important factor. The second one would be an asset class. Especially this has become more prevalent in terms of COVID-19. Is the asset a new economy? Like how is it adapting to the digital trends in the economy? And how are they, what kind of asset class is that? That would be the second most important point. Last but not the least, I would say it's the sponsors and management track record. If the REIT has a good manager and a good sponsor who are committed to growing the REIT, I think that's the most important thing for a REIT to have also.
Okay, thank you. So now we'll come to one of the sponsors, Shaldeen. So Shaldeen, what do you think are the most important factors to consider when investing in REITs?
Well, I definitely agree with Vijay on the 3 points that he stated. Of course, other things that investors will be keen to also look at probably would be like dividend yields, because ultimately that's the dividend that their returns that they're getting. And of course, the gearing, the market cap, and these are some of the key points that investors will be keen to know when they're coming to invest and deciding which REIT to invest in.
And of course, tenant risk. Now, tell us a little bit about your tenant.
Right. Okay. For us, I guess we are quite unique, in a way that although we have always been criticized of having a tenant concentration, which is having just one tenant. However, I guess the creditworthiness of the tenant speaks it all. It's a AA credit rated sovereign tenant, which I would say that none of the Singapore REITs at this point in time is focusing on. They probably have one or two, but it's not concentrated on this. Now, ours is being used by the Department of Works and Pensions, which is DWP, and it's a very counter-cyclical tenant. So when the market is bad, DWP Works has actually exponentially growth rather than being concerned of the tenant trying to move away. What they need is actually they need more space now as compared to under normal times. So that's something very unique about our REIT here.
Okay, thank you, Shaldeen. Matt, what are the most important factors to consider when you want to invest in a REIT?
I'm very, very bipolar on this, to be honest. Part of me says, I want a specialist, I want an expert. So if it's a data center REIT, they need to know everything about data centers, or if it's a sort of UK offices focused REIT, they should just do UK offices. But the sort of fund manager in my head says, actually, you want a variety of asset classes. You want to spread your risk. Different things move to different cycles. I know the general thinking in the REIT universe is that specialist is best as long as your specialist is an expert in a rising sector. And let's face it, we've seen globally over the last 5 or 6 years, REITs who were specialized in retail and hospitality have suffered hugely from being overweight in a single sector that isn't fashionable or is declining. So I'm very caught between the two stools on this one. But I think VJ actually nailed it. It's the quality of the property and the quality of the management team is always the most important thing. But I wouldn't necessarily rush towards what is new and fashionable in many cases.
Okay, thanks. Well, let's stay with you, Matt, because the next question that we've had is about UK property. What are the opportunities for investors and some risks they may face when investing in UK property?
Well, why don't I start with the risks? The UK is facing two unprecedented, unmodelable events in the face of Brexit. The first time a country has ever left a major trading bloc. Obviously, COVID-19. COVID-19 is obviously not unique to the UK. Both of those, I think, bring their challenges for investors. And I think, investors, when they're looking at the UK, are just going to have to take, their own view on these things, because, while I'm paid to have a view, it doesn't necessarily mean it's right. The opportunities, I think, about the UK are that we have a fairly unique real estate market. Leases tend to be very long. They're 10 years or more. It's very easy. It's possible to get 15 or 20 years. The rents, while your tenant is in place, cannot go down regardless of what the market cycle is doing. So your income return is pretty secure. And generally all the costs that are related to occupying that asset are the tenant's problem rather than the landlord's problem. So the UK is always very popular with international investors because it's relatively a fire and forget type asset class. You buy it, you pay someone like Savills to manage it for you, collect the rent every quarter, and that's it. And regardless of the cycle, unless your tenant goes bust, the money keeps coming in, and you can be very predictable about that. Around sort of Brexit and COVID, our clients globally are not particularly worried about Brexit. Sat here, just over a month away from it. There are some who are clearly waiting until next year before committing their cash into the UK, but it's been priced into the market for 3 or 4 years now. COVID, I think, is challenging some and exciting others, and I'm sure we'll touch on some of the sort of the big structural changes later on in this conversation, none of which are particular to the UK. But I guess the only other point I would make about the UK is, it's a very London-centric market. We're a country of one big city. So a lot of the UK asset value is in London offices. So if you're a bear on home working and its impact on offices, that's probably a big challenge to the UK. I don't think things are going to change dramatically in the office market. I think most people will carry on going into the office most of the time.
Okay, thanks for that. Shaldine, your portfolio is entirely in the UK, and they're not all in London. So
Yes.
What's your view on the opportunities for investors and some of the risks that they could face with your particular experience?
Okay, I guess what the macroeconomics is exactly what Matt says. The COVID is always something that no one has expected. The Brexit is something that everyone has been anticipating how it will end up. We entered into the UK market exactly when Theresa May was extending the Brexit discussion every week. So, but as a foreign investors, the whole regime in terms of investments in the UK, it's very open. So it actually encourages investors to look into the UK for opportunities. Definitely, it's one of the most actively traded market. So there is a lot of activities going on in the UK, more focusing on the London, definitely. But then again, there is also outside of London, there are also other major cities that are actually giving better yields as compared to the city itself. So because of our unique tenant, which mentioned earlier, the demand of the assets will be there for a long term. Hence, for us, we are not actually so concerned about going outside of London for investing into these assets, because we know of their relevance in the long term. Hence, in terms of investment opportunities, we do see that London does present a much bigger opportunity. However, there's at the expense of also a lower yield. So in order to make sure that the REIT has a blended yield profile, which also then gives us the confidence that the assets are of relevance, we do actually, as a REIT itself, we are open at looking into the regional cities for such assets. Of course, the better ones are always of more interest than others. Now, in terms of risk, I guess, other than the macroeconomic, as investors, what we see is that, things like the tax regime, understanding of the structuring of the entity on how you invest in, and how we actually managed to, try and maximize the kind of dividend that we could actually repatriate. But I guess these are the things that investors needs to be concerned about when they are entering into a new market and a different country.
Okay, thanks. Vijay, have you had any experience of London property?
I guess Matt and Charlene are the experts here in terms of UK property. But just to add in terms of, I think London or UK still remains one of the global commercial hub and global financial hub. The second thing about UK market is that it's a lot bigger, it's a lot liquid. That becomes very important in a real estate. When a REIT wants to enter a new market, the first thing they say is that how big can they grow? If they establish a foothold, can they acquire and can they grow on this market? And even if they want to sell an asset, liquidity becomes more important. So that is very much present in UK market. That would be some of the other benefits or some of the other opportunities I see in UK market. I think in terms of risk wise, to me, regulatory risk is always one of the key important risks, especially in UK market. Brexit, what happens if some of the free trade agreements don't go through? What happens if European Union plays a hard ball on UK in terms of some of these? So that's a regulatory risk. And suppose if a REIT is exposed to a tenant who might shift their offices or shift their positions post Brexit, is that a risk that should be? Other than this, I think especially for local investors, the other thing to watch out is the currency and forex fluctuation risk, right? If you're investing in a UK, you are investing in British pound. There was one point of time British pound was falling quite crazy. I think the British pound has stabilized at this point of time. So that's something, how the REIT is positioned, how they have hedged their income, and how are you hedging your portfolio for forex fluctuation risk is something which I think investors should take note of.
Oh, thanks. Yes. Of course, the currency risk. Yes,
yep.
And of course, Brexit. Should the financial centre of London should it shift to somewhere in Europe? That's another risk. Yeah, indeed. Okay, so let's address the elephant in the room: COVID. Okay, and which is also in the title of our investment seminar. How will the CBD change post-COVID? Cities are all into mixed-use developments near transport nodes to reduce commute and carbon footprint. And some of these are not in the CBD. So how will this impact properties in the CBD, and how are REITs likely to respond to this? I'll start with Matt, because he works in the World's Financial Centre, London.
I have to say, I'm not a big believer in that there will be dramatic change. I think we tend to over-predict change at the sort of nadir of a crisis. I'm old enough to remember, immediately after 9/11, a lot of people were saying nobody will ever want to live or work in a tower building again, and briefly rents fell on the top floors of tower buildings around the world. And then it came back, and we saw it around Brexit in the UK as well, that there's this speculation that maybe the entire financial community would move from London to Frankfurt, and I think about 7,000 jobs have gone. So I think some companies were very resistant to home working. They didn't allow their staff to do it, or culturally there was this feeling that it wasn't proper work. They've grown up and accepted the fact that you treat your employees like adults. They know where they work best. So I think most people will work away from the office a bit more than they did before. But all our surveys that we've been doing sort of across London and the Europe and the Middle East indicate that most staff want to work in the office most of the time, particularly younger members who are sort of building their career, building their skills. So I don't really see a lot of change. I think there will be increased pressure for high quality buildings, and I think that they will need to tick the environmental sustainability boxes. I think we talked a lot about wellness before the crisis, wellness in the workplace, but I think we possibly didn't do very much about it. We just went to lots of conferences on it. I think there will be more focus on that, but I don't think the structure of the cities in terms of the main asset class offices will change dramatically. I think we will be picking up the pieces of the sort of those who've been mortally wounded after the crisis. Let's face it, the crisis has triggered a huge recession. Companies always fail. And at the moment, the sector that is most struggling in the UK and in London, as in many world cities, is retail and leisure, because they're not open. Tourists are not visiting. Office workers are not going to the office. So we're going to see, holes, as it were, in the high street where these companies have gone bust. And there is a question of how you fill those, and is that an opportunity?
Okay, thanks. Yes, well, there's a lot of concern in Singapore over this sort of hollowing out of the CBD. So I'm going to jump to Vijay, because we are concerned about some of our commercial REITs that are listed here and with properties here, isn't it? Vijay.
Yeah. In terms of CBD, I think overall, if you look at from over the years, I think there has been, Singapore has been trying to diversify some of their office space into suburban, like Jurong hubs, different hubs. But I still believe that CBD has its place. And overall, even if you look at the big companies, when they want to establish a presence in Singapore, the first point they look at is still CBD. So if there could be some changes in terms of mix, in terms of integrated developments, like some of the developments, Singapore is also trying to build residential apartments in the CBD spaces at this point of time. So there could be some changes in terms of more integrated developments coming up in CBD. But I think, as Matt rightly pointed out, we tend to overestimate change over a period of time. And probably in 2-3 years, there could be some changes in terms of how things are in terms of integrated development, but CBD is here to stay for me.
Okay. Shaldi, your portfolio is quite geographically diversified, but I think all your properties are near transport nodes. What is how do you think CBDs could change post-COVID?
I think I agree with both Matt and Vijay. A lot of panic reaction is happening now. People are trying to see, because of work from home, everyone is going to move out of the city center. But I don't think in the long run that is really going to materially change. Probably the companies who are not able to survive through might eventually get out of the CBD area and move to cheaper places. But there's always other tenants that will be coming in and taking after places in the CBD area. So in general, key important things are like transportation, close to amenities. These are the fundamentals of a property when you looked at investment in it. So in terms of the prospects of the CBD buildings, there are still its attractiveness, despite the current COVID situation. It probably would take about a couple of years to go through when COVID is over, but in the long run, I don't think it will be out of it will change, as in like people will totally get out of the city area. So it's still the place whereby most of the things could be found, and people will sort of come together. When you do a business, yes, we have been doing a lot of Zoom calls now, just like this webinars, but then day-to-day contact and sort of like communications within the community is still very much required.
Okay. So let's move on to another topic, valuations, okay? Because there have been COVID has actually impacted some valuations, and we've seen that with our retail REITs here. Okay, so what are the metrics that valuers consider when doing valuation, and how is the pandemic impacting these valuations, and how will this affect the REITs' valuations, their net asset values, and do revaluations have an impact on management fees? Now, there's that's a lot to swallow. But I'm going to ask Matt what he thinks, because he's with Savills, and I know Savills does valuations here in Singapore. Do they do valuations in UK?
We certainly do, and we'll be delighted to value for any of your watchers and listeners, obviously. I think it was Shaldine or mentioned earlier, the UK, one of the things of the UK is it's a highly regulated real estate market. So there's the Royal Institute of Chartered Surveyors who lays down valuation methodology. They intervene if we are not following it. And indeed, they act as an arbitrator if the two parties cannot agree on it. It's also a very transparent market in a sense that, all the big firms of valuers and agents like ourselves have research teams that employ people like me, and we publish all the deals that are taking place in the market. So you don't need to rely on us to, what us telling you is right. You can look at the market and see all the deals that have happened and check the value. So I think that is a huge factor for non-domestic investors, because you need transparency as well as liquidity, and I think the UK is probably the most transparent real estate market in the world. Valuation, however, is tricky at the moment, and valuation is very tricky in a period of low liquidity, and at the moment in the UK market relatively few transactions are happening, primarily because of the difficulties of transacting in a lockdown period. Many of the clients who want to buy assets can't visit the UK because of travel restrictions, and so on and so on and so on. But in a period of low activity, valuers are only allowed to value based on evidence. They can't say, well, a hypothetical value would be. They would have to say, I'm comparing this asset with these assets that have recently traded or been leased, and therefore the value is X. At the moment, it's very difficult to put a value on anything in the UK because there is no comparative figure. I can tell you that it would probably get X, and I'll probably be right, but from pure sort of desktop property valuation, it's a very difficult time. And that is probably a note of caution in a sense that sort of valuations in the UK do tend to lag the market cycle. And they do slightly underestimate the peaks and troughs as well. It's just something to watch.
Right. Okay. So, Vijay, when you're doing analysis and your recommendations, do you look at the valuations, the capital values of the properties when you value your REITs?
Yes, I do, Goola. Again, I'm a firm believer that valuation is both arts and science, right? Valuation has a lot of assumptions behind it in terms of you have to forecast on the future rents. I mean, how would you forecast a COVID kind of scenario when you are forecasting a future rents? So there is a lot of assumptions behind valuations in terms of valuations and deriving valuation metrics. Typically, when we look at valuations here in Singapore, usually valuers use three methods, which is discounted cash flow, capitalization rates, and comparison approach. And the most prominent one, which is being used, is discounted cash flow approach. Despite this crisis, I think valuations so far have not been impacted like past crises. I think the key reason here is low interest rates. When there is a low interest rate, the cap rates don't change that much. And there is also abundant liquidity in the market. We do see a liquidity in the market. And as Matt rightly pointed out, there has not been much of distress sale like past crisis, where you can take the cap rates as a reference point and then change the valuation methodology. So overall, yes, we do definitely take valuation into consideration in terms of considering our analysis in terms of every REITs. And property is a hard asset class. So price to book is a key metric which we use for valuation also.
Yeah, okay. Shaldine, when we last had a conversation on your acquisitions, I think I gave all of you, your panel, a hard time on passing rents versus market rents and so on and so forth. So I wonder if you could expand a little bit about the valuations in elite commercial REIT in terms of how your buildings are valued. In fact, there's a question from the panel, from our audience, from actually Koo Swee Yong, who's asking about the valuations of your buildings because they're based on master leases. I've asked this question to you before. So is there a secondary market for these buildings, he's asking? Yeah.
Right.
And
I guess
how confident can you be of those valuations? Yeah.
Right.
Indeed.
Okay. Thanks, Goola. I guess just to clarify, the REIT actually doesn't have a master lease like a lot of other REITs in Singapore do.
Doesn't,
So
right? Doesn't.
every
It's got a
property
long-term
has its,
tenant. It's got a long-term
yes, we
tenant.
got a long-term tenant whereby each of the building has its own individual leases. So the valuations of the REIT has been based on the income method, whereby it takes into account the cash flows of each of these properties. Because of the long lease terms that we have, things has been considered. I guess in terms of the whole portfolio per se, our valuation has been very conservative. The valuers that has been looking at it actually has put in a couple of assumptions. Yes, some of these buildings are in not the major London City or Birmingham or Manchester City. However, these are the places whereby I guess the government needs the space more. There are a lot of considerations behind the long-term use of the building. So there are certain commitments by the government requiring that every citizen should be able to access to a job center plus within 25 minutes transport time. So and then you will need to see on the surrounding area, is there any other similar kind of properties? Having said that, in our portfolio, we have assumed very conservatively at the break clause year, which is in 2023, 50% of the leases is expected to be broken on that assumption. Although we know that the government is unlikely to break that many options or leases at the time, due to the not only due to the COVID, even prior to COVID, we don't think that's going to materially happen. Well, they have gone through a round of rationalization before they decide which are the buildings that they need for a long term. Hence, they signed a 10-year leases. But in all other long leases in the UK, it is very typical to have a 5 years break clause sort of like inbuilt into the lease. It's not saying that they will break the lease, but then that gives them flexibility. And in terms of the rental rates negotiations, if you sign a full 10-year lease without a break, it's probably going to be a lower rent rate compared to one with a 5 years break. So these are the considerations that has been built into the leases. And when the valuers looks at the lease itself, taking into account very, very conservative assumptions, we believe that the value of the REIT, it's very conservative. Having said that, the second questions that you have mentioned is that on Sui Yong's questions was that what if we do have to put up some of these buildings into the market, right? What's happened to the value? Is there a secondary market to this? One key important factor when we looked at properties in the UK was we realized that there's permitted developments rights given to commercial buildings, which means that the commercial properties has the right to be converted into residential, and doesn't have to go through a long process of getting it the developer's license stand up accordingly. So which means that there are alternative usage of the assets. Well, of course, as the REIT is a commercial REIT, our key primary objective will be to continue its use as a commercial property. But should it be a day whereby we think that there is actually a better returns from that property for other usage, there is also nothing stopping the REIT to be able to recycle some of the capital. One of the examples that I think we have put in our prospectus was a property in Preston. We have a neighbor which is identical to the building that we have bought. I think it was previously also used by the government, but they have actually vacated. The building being sold empty to a developer and is being converted into an apartment is sold at a price similar to a 10-year lease that we have. So fundamentally, there is already a base minimum of the valuation of the assets in there, where we think that we could preserve. So I would say that not every property will be similar, but majority of the assets that we have are located in like key prime town centers, whereby that is actually accessible to a lot of amenities and also transportation, thus provides that kinds of opportunity as well. So and even after we have acquired the property, we have been receiving a lot of unsolicited offers for conversions of the properties into old folks' homes. I mean, sort of like the OH homes or the apartments or other usage. It's quite enormous that I was quite surprised, particularly at certain areas which are more popular for such usage. So definitely for the REIT's perspective, we don't expect that there will be a huge discount of valuations should we need to consider a second use of the property itself.
Yes. Okay. Thanks for that. And also, I remember giving you a hard time asking for comparative valuations because you value your properties based on income cap and DCF,
Yes.
isn't it? But
Yes.
but if you compare them, and I think your CIO went on a long. He explained that comparatively they are lower than adjacent properties.
Yes, actually, I think I've mentioned that in my presentation recording yesterday. Just take, for example, the building that we have, or we are going to acquire in London itself. The one that is actually close to Finsbury Park, that is actually leased out only at £18 per square foot per annum.
Yep, that's
so it's probably not a grade A building, but it's in a location whereby you could do something about the property and bring it up to a much better level should one day, if the government decides to leave. And with that location, if we just compare it to the neighboring leases, which is probably leasing out at about £30 per square foot per annum, there is definitely some room whereby we can actually enhance on the property to achieve that kind of rental rates. So these are just some of the examples of the properties. Why the rates are so low is because the government requires it to be very affordable. I don't think any government in the world would want to pay very high rent on properties. And in order to entice them for a long lease, we have it at that rate.
Yes. Okay, so stay there, Charlene. The next question is on long WALEs. Okay, WALE stands for weighted average lease to expiry, because I think in the UK it's called by something else. But anyway, so long WALEs are important for stability of distribution. We all recognize that, and your assets, your portfolio has long WALEs. But however, there are rental escalations that are built into long leases, and we've come across this in properties in the US and Australia. And so is there a danger of a cliff effect with negative rental reversions when leases are renewed and rents are marked to market? Okay, that's one question. And the second part of this is, what would the solution be for such cliff effects?
Well, I guess rental rates escalations, typically grows in tandem with the inflation rates. So there is a steady growth. And of course, if rents are structured in such a way whereby it's a fixed rental growth rate at a very high percentage, what it ends up is that it's actually doesn't matches the inflation growth. And hence you have, at the end of the lease term, a very high rental rates. But when you look at the market rental rates, it's actually much lower than that. So that forms that cliff effect that you're mentioning here. But I guess what we have in our leases is that we have actually got a lease which is actually linked to the CPI index, and with the floor and cap as well. So even if the CPI happens to grow beyond 5%, we will not get the above 5% growth rates. So it's sort of like being moderated out and ensure that at the end of the lease terms, we are still in line with where the inflation rates are going. And that helps in terms of stabilizing or preventing some form of a cliff effect, for one. And of course, if as a portfolio manager, we can actually diversify the leases into different years, and that's where where rental rates are growing at different rates. Then you won't also have that concentration of lease expiry with just one kind of market rent rates that's happening on that particular year that you're seeing. So these are probably some of the ways that we can look at in terms of structuring our leases to ensure that we don't have that effect. Well, of course, if you're able to do more asset enhancement into the buildings, upbringing the quality of the building to a different level, which actually takes into account a different kind of rental rates, that is also some way that you can actually manage to sort of like stabilizes the rent more, rather than you see a lot of like pith and troughs in your rental rates.
Okay, thanks. Okay, Matt, you mentioned long leases in your presentation for the properties in the UK. is there any concern over cliff effects where, your passing rents are a lot higher than your market rents, and when the leases are up for renewal, there is a mark-to-market effect downwards in terms of rental reversions?
Not really, because actually the kind of indexation that Charlene has on her portfolio is relatively uncommon in the UK. Relatively uncommon, but highly sought after by investors. But yeah, you may get it sort of on logistics property more commonly, occasionally on leisure property, but it's quite unique. One of the, perhaps you might argue that one of the challenges of UK real estate is the lack of indexation, in the sense that if you were to buy an office property in Birmingham at the absolute top of an economic cycle, it's possible that in 5 years' time, when your rent has been reviewed, the rent hasn't changed, and then in 5 years' time, it still hasn't changed, and then in 5 years' time it still hasn't changed. So you get zero rental growth over a 15-year period, just because the economic cycle moved against you. It can't go down, but indexation is sort of highly sought after. And yes, I think we all know that it does create the potential for a cliff edge. But actually, for office property, I always find myself saying, the bigger challenge is not the cliff edge. It's that the property is getting older and older and older. And you have obsolescence is probably the biggest challenge to people investing in offices, because fashions change, tenants want more. And at some point, the owner of that asset has to write a big check to pay for upgrading that building. I think that's a far bigger challenge than a cliff edge in rents.
Okay, right. Okay, Vijay, we've had some REITs that have problems with these cliffs. Yeah, what do you think is the solution to them? We know that some of them passing rents were much higher than market rents, and there were a very sharp negative rental reversions because of that.
I think Matt and Charlene talked more about the indexation effect, especially in Europe markets. But let's say in markets like US and Australia, where you have is that they have a long leases with inbuilt rent escalations, meaning this is not dependent on inflation, which is non-existent at this point of time. The leases are escalated every 2-3% per annum. So what happens sometimes is that if there is a 10-year lease, and at the end of the 10th year, the rents would have escalated by 30%. And suppose if the market rents haven't kept in track with this kind of escalation, you would see this cliff effect happening. So what can be done? I think one is more disclosure of information. So if you are seeing overseas REITs in particular, nowadays they do give a breakdown in terms of what is the market rent versus what is the passing rent of each and every individual property. By this way, investors are better informed if there is a cliff effect, whether the inbuilt rents in the properties are keeping in track of the market, or is there going to be a cliff effect. The other ways are avoiding is, of course, in the management. So if the management is aware of such a cliff effect to happen, how are they taking proactive steps? Are they at least communicating to the investors that there is a risk that this property is over-rented? So we do expect some sort of downward revision from these properties, which investors should watch out for. Of course, Charlene talked about balancing the risk in terms of spreading out weighted average lease portfolio, as well as having a mix of ones with longer lease and ones with a shorter lease can help in some words of balancing this risk. So the key thing is information, provide more information to investors so that the investors can judge for themselves how big the cliff effect is and how are you taking steps to balance this effect by diversifying your portfolio.
Yes, indeed. And that's also one of the reasons why we see our REITs growing bigger. They're merging and they're making big acquisitions just so that they can diversify their whales, yeah?
Yeah.
Okay, so let's move on. Okay, we will come to the questions from the live questions from the audience in about 10 minutes, okay? But I just want to have a couple more questions from the previous, from the questions that were sent in by our viewers. And there is one question which is quite interesting on the advantages of an externally managed REIT versus an internally managed REIT. There has been a long debate of which types of REITs are more efficient and provide better return to investors. And we have a case in Singapore where a couple of hedge funds want to requisition an EGM to remove the manager and internalize the REIT. So I just wondered whether the panel has any views on this. Could we start with you, Vijay?
Sure, Goola. I think there has been a long debate in Singapore of which one is better, whether internal or external is better. My personal preference is that I would say in a small domestic market like Singapore, where acquisitions is very competitive and you don't have, when you face very difficulty if you're being a small REIT in terms of acquiring a portfolio, etc. An externally managed REIT with proper checks and balances works well. Singapore wants to become a REIT hub. How big a market you have? If you want overseas players to come and list in Singapore, I think you need an externally managed REIT that has become. But what is more important is that externally managed REIT should have proper checks and balances. It has been proven, right? The amount of growth what Singapore REITs has seen in the last 20 years, it actually took 50 more years for markets like US and Japan to achieve the same amount of growth. And that's mainly because it's externally managed REITs. Even in this market, there is a steady pipeline of REITs that want to list in Singapore. The reason is because it's also externally managed REITs. But the key thing is that you should strike a balance in terms of regulations to make sure that such kind of happenings, or a REIT list for the purpose of growing the dividend income. A REIT should list so that the sponsors, the investors can grow the dividend income along with the people who are listing the REITs. So there should be my personal preference is externally managed REITs works well for Singapore, and that's the model to go. But where and when needed, increase the regulation to make sure that such a kind of happenings doesn't happen in REITs. For example, the case of Eagle Hospitality.
Okay, thanks. Okay, Shaldine, well, yours is an externally managed REIT.
Yes.
What would you say to those that think that it could be, their DPUs could be higher if it was internally managed?
Okay, I guess people always complain about why externally managed REITs are not actually in favor. Was more because of the how they have been incentivized, the fees that is being paid. So I guess in Singapore, what has been very clear is that the REIT managers' fees are paid, or more, at least if you see all the recent years listing, the form has changed, and basically they are incentivized based on the returns of the unit holders, so they are aligned. One, I guess that's what Vijay has mentioned as well. Two, which is one very important other factor, is the governance and also the transparency. So we do have a very stringent governance for REITs in Singapore. The amount of disclosure that we're required to make is extremely huge. So that gives confidence to investors for external manager. In addition, we do need to have a board which is more than 50% or more being independent directors, should it does not require unit holders to approve the board members. So the presence of a large amount of independent directors actually serves to scrutinize what the managers are doing and make sure that they are actually working in line with the governance policies that are put in place. So that is one very important point that gives assurance to investors of a externally managed structure. Well, of course, there is also added advantage as external manager is that we could be able to tap on the sponsor's expertise, tap on the sponsor supports when it's required. So I do see that in the long run, especially in Southeast Asia or in Asia Pacific, except for Australia, this model has worked and it's proven that it can work well. So I do think that the external managed model does works for REITs, as long as the key criteria is adhered to, transparency and governance.
Okay, that's great. Okay, so we're externally managed REITs have worked for Singapore, and they work very well for Singapore. So don't change something that isn't broken. But now we'll stick with Shaldine, because we have some questions on elite commercial REIT. So, so there were a number of questions, but I've sort of tried to amalgamate them. And stay with me, Shaldine. So comments on the possible dilution of the existing units due to your recent acquisition. Okay, that's question one. Have you got that?
Oh, yes.
Okay, one sec. Okay. And then, so there's a question on the, okay, we'll do them one by one. All right. So dilution, yeah. Is there a dilution? And some obviously investors are concerned about
concerned with. Okay, I guess we have made it quite clear that the acquisitions that we are making is accretive. So in our base case, we are talking about a 3.2% accretion with a small fundraise that is going to the market. Now, so this is not a dilutive acquisition. So I don't expect dilution in our units. Should the market be non-conducive, as in like we can't do a fundraise immediately to complete the transaction, we have also ensured that the structure itself could ensure that we can complete the transaction with the debt that we have in place. Of course, that means increase a bit more gearing, but that also implies that the accretion is much higher on this transaction. The highest amount of accretion that we can actually achieve with this would to come to be about slightly above 8%. But of course, it's not the objective of the REIT manager to have a higher gearing in the long run. Our intention is still to do a small raise as per our base case scenario, and then to bring it down, bring down the gearing to a level that we are comfortable with, which is about 37% in our base case, with a small raise, and it's still accretive. So that's where we are looking at. So it's not a dilutive acquisition here.
Okay, so the other question was it NAV dilutive or was it not? I think it was neutral to NAV, right?
It's neutral. It's still about 61 pence. Yes.
Okay. All right, that's fine. Okay, so there's another question on your borrowing costs. Okay, so what are your borrowing costs? Someone said it's 2%, and can this be improved? I think there is more than just borrowing costs, isn't it? There's the ICR, the cover ratio, the interest cover ratio, which is also quite good on your REIT, isn't it?
Yes.
So,
yes.
Yeah, could you give a comment on that? And I think the questioner is asking whether you could get lower interest rates because of the quality of your tenants and the occupancy rate.
Right. I guess the rent rate, the interest rates that we are taking now, it has actually built on the base of the stable rental incomes that we're collecting and the quality of the assets. Now, it's a very competitive sort of like borrowing rates. It's actually something that we think it's actually something we think that is actually in line with the market. So we have borrowed our borrowings from UK, and it's actually in pounds. So actually, we do see a decrease in our cost of borrowing since listing. We have actually reduced this by about 30 bips since the point we list till now, because 50% of our loans are actually on fixed rate, 50% is on floating. So on the floating part, of course, we have been benefiting on the lower interest rates in the market. But we think that this is actually a prudent mix. It is not the REIT manager's objective to be speculative on interest. So with this particular interest rates, we think that it's prudent. And in terms of ICR, with the new acquisitions, even at a gearing of 37%, we are looking at about a 5 times ICR, which is also very healthy for a REIT as well. So in terms of the rates, we do think that the REIT's interest rates is quite competitive and compelling into that we have structured in.
And what portion is fixed? Is there a portion that's fixed, or
yes?
What percentage is fixed of the borrowing?
Currently, we have 50% of our loans fixed and 50% on floating rates.
Okay.
So we have managed to at least sort of like make sure that we know how much we are paying on half of it, and the other half is actually still benefiting on the lower interest.
Indeed, lower interest rates. Yes, indeed. Okay. So we'll take a question from the current viewers, and okay, this question I think we'll start with Vijay. Okay, Vijay, Singapore listed REITs with overseas assets trade at substantial, like Manulife US REIT over here, that is an example, and of course also Elite, although I know that your incoming unit holder believes that Elite should be trading at 4% because of your tenant, it is still trading at like 6 to 7%, isn't it?
7.
Yes. 7%, right. Okay. So, all right. So Singapore listed REITs with overseas assets, and this is not just Manulife and Elite. I think even Cromwell, I think it's like 8 or 9% now. Okay. Trade at substantial discounts to their REITs listed in their own markets. Why is this so? And how can that discount narrow? Could you try to take that, Vijay, first, and then we'll ask Shaldine what she can do to get tighter yields on her REIT.
I guess, Goola, the obvious answer is firstly investors' familiarity. Always investors' familiarity plays an important role. Investors know about capital, and it's again comes back to the issue of how much I know about this and how much premium I can pay. Many investors are still in a learning path for markets like US and UK, and Singapore has also had a past history on some of the overseas companies listing here hasn't delivered up to their promises, and that has happened in the past. So it takes time for the investors to get in grasp with overseas markets, overseas assets, overseas regulatory environment. So that's been building up. So that's why it is very important for overseas listed Singapore REITs to educate the market, to properly educate the market in terms of what is the asset positioning, how is the market, what is the regulatory landscape, etc. So it is more of education perspective was the first part of the equation. And the second part is again the trust with the sponsors, right? Some of the overseas listed REITs we have seen recently is that there has been a trust issue. So it becomes a sponsor. So it becomes which sponsors and what is the track record. So I think the key here is to educate the market in terms of both in terms of assets as well as the sponsor, and eventually things will narrow. You are now seeing that more Singapore REITs are going overseas. So that is also a way to educate the market. You are seeing Ascent buying US, UK, big REITs are going overseas. So that would provide much more education. And eventually, once the investors are educated, the discount will automatically narrow.
Okay, Shaldine, I know that one of your major unit holders, who's incoming unit holder, thinks your REIT should be trading at much lower levels. What are your thoughts on that?
Yes, I guess if you look at how the REITs are trading in the London Stock Exchange, we are actually quite a premium to them. We provide a higher yield to it. Like what Vijay says, is education. People are not familiar with the sector, is not familiar with the country's perspective. Unlike anyone that is investing in Singapore, understanding the whole REITs market, which has been around for years, they understand the basics. They are familiar with the sponsors, and whereas people like us who has gone to the UK, first, it's not only the sponsors, it's actually UK itself. Questions always pops out. Why are you going to UK and there's Brexit going on? There's yes, this always comes back as question again and again. So it's the familiarity with the market. The openness and the amount of data that is that's available in terms of for investors is very different from what we get in Singapore. Like what Matt has mentioned, you can almost get any data in terms of transactions, past transactions in UK. So, and completion time of acquisitions is so much faster. We have seen a property similar to what we are investing that was put on sale in London during the lockdown period. It was put onto the market and was completed within 7 days. So that's the kind of speed that they are able to do because of the information that's being available to investors. So these are things that our investors need to understand when they come to a REIT. They need to understand the market. They need to understand the REIT itself. So we believe that in the long run, with continuous education and also to ensure that the REIT is moving at the right direction, confirming and proving to investors what they are delivering, I think that will give the confidence to investors in the Singapore market to invest in foreign REITs. And that will eventually bring down the yields to a level which we believe where it should be.
Okay, thanks. Thanks for that. Well, just to stay here, Charlene, for a moment. There was a question. I think it's just disappeared. It was on the on the tax. Is there a tax leakage? I know that some foreign REITs have tax leakages, and some of them have give all that they manage to have actually no tax in the foreign jurisdictions. Because in Singapore, we all know that there's a tax transparency if you have local assets, and there's no tax on the REIT. There's no tax on us investors when we on our DPU either. Could you just give an indication of the tax leakage at the REIT level?
Okay, I guess for elite commercial REIT, we won't say that there's actually a tax leakage. We do pay corporate taxes in the UK. So other than the corporate tax that's being paid locally, there's actually no other taxes that is actually chargeable to the REIT when we talk about dividend remission back to Singapore. So it's the same. So it's only the local corporate tax that we are paying.
Do you get a lower tax if you have a certain structure? Like I think in Australia we have the managed trust regime where you get a 10 or 11% tax.
Not on the structure that we are having. However, I guess it's always in the back of the mind of the REIT manager. We are exploring and seeing that, with consultations to a lot more tax advisors, if we are able to enhance the tax structure, we'll definitely quickly do that and bring that benefit back to our investors here in Singapore.
Okay. So, Matt, are you still with us? Because it's very early in the morning. Is there You're still there, right? Is there any way we can get the lowest tax possible as Singaporean investors in the UK? What's the best way? And I'm sure you've advised people on this. Now tell us.
No, absolutely not. I don't give tax advice, and I'm not going to start now.
Okay. So is there any structure for a fund or a trust, a property trust, to get a more efficient tax rate?
Again, it's not my specialist subject. All I would say is the UK is relatively unique in a sense. We don't tax non-domestic investors differently to domestic. So, it's a level playing field. You come and buy property in the UK, you pay the same tax as locals, unlike if you go to the US. I'm sure there are ways around it, but, consult a good firm of accountants.
Okay, so there's another question from our viewers, and it's similar to a question that I've skipped here, and that is which asset class offers the best value in Singapore today? And we had this question, we had a question earlier, what REIT sectors are likely to be the most promising in the next 3 years? Retail, commercial, industrial and logistics, hospitality, healthcare, or data centers. Maybe we should start here with Vijay. Maybe Vijay, you could take this first, and then we let's ask Matt what he thinks are the best asset classes, the outlook for the best asset classes in the UK.
Okay, Goola, I think I would take this question from an income resilience and demand perspective, right? I mean, there are two ways, right? The data centers. I mean, from a resilience income demand perspective, it's data centers, definitely the most promising asset class, followed by logistics, which has also been most promising asset class. And I would say business parks and healthcare would rank subsequently, right? Again, these are all from an income resilience perspective. Of course, REITs has a two sides of coin to it, whether valuations, how much valuations are factored in. But purely from a perspective of income resilience, demand, where there is going to be a lot of demand, the preference is data center, logistics, healthcare, and followed by, I would say, business parks.
Okay. Matt, what's the outlook for UK property in terms of sectors then?
Yeah. I think, I would generally agree with Vijay. I think, logistics has been the world's probably most popular real estate asset class for, quite a number of years now. And I think there is no doubt that it will continue. And if you're looking at the UK, we have a very high adoption of online shopping, and it's going to continue to rise. And if I was looking at other parts of Europe, I would say the same thing's going to happen. So I would probably buy logistics, but it's very, very expensive. Right.
The yields are very tight now, aren't they?
Yeah.
Logistics, yeah.
Everybody wants to buy it, and this is not a UK story that, yields for the first time ever on logistics are pretty much around the world are lower than yields on retail. Slightly contracyclically, I'd look at bits of retail. I think this sort of blanket repricing of saying all retail is bad, we will never go to a shop again. is wrong. And I think we're seeing a lot more investor interest in what we call in the UK and in Europe retail warehousing, which is, relatively cheap warehouses full of furniture and carpets and white goods. They've proven to be very COVID friendly, good for social distancing, lots of car parking. They've repriced it in line with the rest of the market, but the type of goods they sell are not the type of things that people buy on the internet. So I think there is a bit of a contracyclical play there if you're an expert in retail. But, again, amongst all the noises about seniors housing and data centers, these are tiny, tiny asset classes, just in terms of the direct market. And if you wanted to buy a REIT share that in these, some of them are almost non-existent. I think, most of the money will end up going to CBD offices. It always, as investors go to a risk-off strategy globally coming out of a recession, they say we'd like to buy all these things. And then they go, well, the only liquid area of the market is big office buildings in London, Paris, New York, Tokyo. And that's what they will buy. And that's where the performance will be.
Oh, okay. Charlene, you don't have much choice because you've only got commercial property. But if you had 100 million and you were going to start your own REIT, what would you buy?
We are not just commercial property. The uniqueness is that we are actually very much an infrastructure related commercial property.
Right.
So it is very unique. It's different. It's despite COVID or despite a downturn, we are there to stay. And even in the good times, the growing population of the aging population in UK is the one that requires the facilities for pensioners. So we are always there. So I'll buy elite commercial REIT then.
Okay, so everybody, that's the takeaway. I've got one more question. Look, there is another elephant in the room, and that is interest rates. Okay, so I think this will be the last question. So what are the panel's views on the direction of interest rates? Would a post-COVID-19 economic recovery cause inflation and hence put upward pressure on interest rates? Because we know that interest rates are very pertinent to REITs and affect REITs in at least 3 to 4 ways. Vijay, you start.
I think the talk about interest rates rising has been there for quite some time.
Right.
And especially in a post-COVID world, I think the focus now is not on interest rates. Even if you look at central banks, they have been adjusting their targets, like job economy as well as job restoring back the jobs is the most pertinent target which they have rather than inflation. Even Fed has come out to say that the 2% target which we had is going to be an average target. So I think inflation is at least 2-3 years out from now, and that is not the main concern we have at this point of time. Whether there will be hyperinflation, whether the inflation would come back strongly or not, I don't have an answer to it. But I think at least for the next 2-3 years, inflation is not on the horizon. That's my view. So from an inflation perspective, I don't expect that to impact REITs in the next 1-2 years at least.
So you don't expect interest rates to rise? Okay. Charlene, in your portfolio, are you even considering that you should be having a lot more of your loans hedged, or do you think interest rates are going to remain low and you've got the right amount?
I think we do have a right mix, but in the long run, interest rates might increase, but it's not going to be immediate. We don't see the economy recovering immediately after COVID. The impact and the effects will last out for a couple of years more. Of course, at the back of it, there's still Brexit that's overhanging. It depends on the outcome, the economy, it's how it's going to perform. We expect that in terms of the pound sterling, the interest rates is going to remain at a low level for quite a period of time.
Okay, Matt, Brexit. Does Brexit have any impact on interest rates?
Well, I suppose it could. If there was a massively disorderly Brexit and everything fell apart and it was a bitter divorce and the UK economy suffered, then interest rates theoretically might have to go down. But there's not a lot of headroom, and I think people have been, as Vijay was saying, people have been predicting the normalization of interest rates pretty steadily since the global financial crisis, and it hasn't happened. If you wanted one thing that economists consistently get wrong, it's interest rates going to go up next year. sat where we are today, most governments on the planet have their debt to GDP ratios are at record levels. There is no prospect, I see, particularly in the sort of Western economies, of a sharp rise in inflation, and hence a need to move interest rates. They will go up, but they're not going to normalize back to the levels that we saw in the 70s, 80s or 90s. So I wouldn't worry about interest rates. There's a lot more things to worry about out there than that.
Oh, okay. Thanks, Matt. You can go off and have breakfast now, if you'd like, because we've run out of time. And so thank you, everybody, for joining us. And thank you, the panelists, for joining us today and sharing your great insights. And thank you, audience in the digital world. I hope we can meet face-to-face sometime next year. Yeah. And to our viewers, if you've enjoyed today's discussion and would like to follow our updates of the REIT sector, do subscribe to us at www.theedgesingapore.com. And should you wish to receive the slides for the past sessions, do share your feedback in the survey form on the screen now. Okay, thanks again and have a great weekend.